Hit it.
It's Friday, June 24th, 2022, episode 184. I'm Patrick Ceresna. Kevin is on summer vacation, so Lena and I are running the show. This week, I welcome back to the Huddle, a Huddle favorite, the Chief Market Strategist at Interactive Brokers, Steve Sosnick. We're going to talk Fed, recession risks, the bear market, and more. Afterwards, Steve will pull out his crayons and join me for some talking charts, and we'll be back to our normal format next week. So, Lena, hop on. We're doing things a little different this week, right?
Yeah, that's right.
We have a beer, but we're actually allowing Steve to do the feature beer, and he's going to give us a rating on it. So a little bit different. We'll be why don't you just quickly say what beer he's going to have, and then why don't you give us a quick little disclaimer?
Sure. So Steve will tell us about Two Roads Brewing Company's No Limits Hefeweizen. So we can find out what that beer tastes like towards the end of the interview. So you got to stick around for that. And just to go over a disclaimer here, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. And those professionals are not Patrick or Kevin. Side effects of too much Huddle may include yelenitis, Ethereum delirium, and this is an oldie but a goodie, inappropriate Lacey Hunt posters.
All right, let's get Steve on the show. So we have the great pleasure of having one of our Market Huddle favorites, Steve Sosnick, coming back on the show. Steve, great to have you back, bud.
It's my pleasure to be here. Thank you so much once again for having me. And although, I got to say, we got to see if this is a better way to go, one-on-one instead of the usual two-on-one.
All right. Well, we'll find out. Anyway, so Steve, we decided to do things a little bit different because every time we've had you on, you've always indulged and enjoyed a beer with us while we were huddling. And, we figure, why don't we have you feature the beer? And so why don't you tell us the beer that you're drinking today?
Right now, I have a Two Roads No Limits Hefeweizen from the Two Roads Brewery of Stratford, Connecticut, just up the street, not far from New Haven, where we still got to go for pizzas. That COVID interrupted
Absolutely.
that one. But I'm holding you guys to that. So we're gonna crack this one open. I've had several of their other beers, never this Hefeweizen though. So
all right. Well, listen, I'm gonna ask you to at the end of our little episode here to rate the beer. So make sure you kind of highlight some of the things about it, and we'll get your opinion on it at the end of the thing. The other thing, Steve, which I wanted to talk to you quickly about before we get to the markets, is last time we had you on the show, you gave your son Charlie a plug, then told all of us to follow him on Twitter. So those of our listeners that aren't familiar with Charlie, he's a up and young comedian, and he's got a little Twitter handle. And Steve, I have to admit, I followed it the moment you told me. And over the last many months, I've, whenever it popped up, I kind of peeked at what's going on there with the youngin'. And he's quite funny, bud. It's
Well, thank you. I don't know where he gets it. Certainly not from me, but no, he's there's some good stuff going. The timing of him starting was terrible because he'd just started to get some traction, and then COVID came. But he's back doing it. He's got a monthly show in Brooklyn, which he's actually taking to Los Angeles in about a month, and it's called Petting Zoo. And they basically have other, I was going to say up and coming comedians, but some of them have been fairly big time because they like the idea of performing while holding a monitor lizard or having a python around their shoulders or a cockatoo on their head or something, which is their little thing. They do it in conjunction with an animal trainer. And so other comedians love it because it helps their Instagram presence. And it's building their own, these guys have been building their own, him and his partner, Michael. And his other gig, which keeps me from having to write checks every month, is he has become a cryptocurrency promoter.
Oh boy.
I won't mention the companies because it's not really public which ones he's doing. Um, but he started with one client. One client saw one of the crazy videos he did that was a restaurant review, and said, this is exactly what we need to promote our software that we haven't yet written that will link to crypto protocols that also haven't yet been written. Uh, and and from there on, he actually has a business. He has a few different clients. He tweets for some of them. He writes ad copy for some. He's a good writer. He's got two books out there. He's actually, his latest thing is he developed a capsule collection, as they call it in fashion land,
There
of
you go.
ridiculous stuff. It's actually, I think his Twitter handle now is Capsule Collection by Charlie Sosnick, because that it's a bit nutty. I don't know if you've seen those pictures of like old men on the beach modeling
Oh,
his stuff.
I
But
unfortunately did. Those certain things you can't unsee
yeah,
afterwards.
that's the problem. But so be it. But again, this is his comedic sensibility, and just for equal time, my other son just moved home from Japan. He was a he was doing travel marketing, bilingual travel marketing in Japan, but unfortunately, with them having shut down travel and only reopened it recently, he decides to come home and go to law school. But
There you go. Well, that's great. Well, listen, I'm enjoying following him, and I just wanted to give it a shout out. All right, but Steve, let's talk some markets. By the way, for our listeners, Steve is going to take Kevin's place today and join me to talk some charts afterwards. So what we'll do is go through just some bigger picture stuff to talk about, and then we'll take a deeper dive into some of these topics when we're actually looking at the charts afterwards. So, Steve, like I was looking on the Interactive Brokers page where you were writing a number of these articles. And so I'm just going to go in chronological order of some of the older ones to the most recent ones, just to talk about some of these things. Particularly, you highlighted in one of your articles about just how these safe assets, and particularly some of these shorter treasury yields getting clobbered, really is a stress point for many of these risk assets. So why don't you share what was on your mind?
yeah, well, this was, when we think about what happened to treasury yields over the past, pick a time frame, a couple months, couple years, well, not a couple of years, couple of months, couple of weeks. We've had epic declines. I mean, we had 75 basis points in about a week leading up to the last Fed meeting. We've since come back from, and those are in 2 years. I'm sorry, 75 basis points on 2 years. Those aren't supposed to move more than a
Yeah.
few basis points here and there. And we're up from about 1% at the start of the year to we were getting about three and a quarter. We're now, I guess, back and we've improved more or less to 305. But the bottom line is this: people are wondering, why is the stock market so weak? And if there is no safe, if the safe havens are performing poorly, if risk-free assets, which a 2-year treasury is about as risk-free as it gets, there's no credit risk, and the duration is very short. You really shouldn't have these kind of moves. If those kind of assets are declining, what hope do you have for risky assets? So of course stocks were going to decline in the face of that. And now we've come off our lows in bonds. Coincidentally, we've come off our lows in stocks. I do think they're going to be moving together for a period of time, until or unless we have like a true recession or inflationary spike or something of that nature. For them, in the most part, they're just going to follow each other, because you can't value risky assets without using risk-free assets as your base. Think about every pricing model. There's a risk-free asset price somewhere in there. And so again, if there's instability in risk-free assets, by definition, you're going to have instability in risky assets. And I think that is something people have to keep in mind when they're trying to figure out what's going on in the market. And by the way, we had a very nice update today. Particularly if you're on the long side, a great up week. We basically had Nasdaq up 7%, and IWM, the Russell 2000 was up big today, about 3%. This is volatility too. People always say, when is the volatility? Oh, the volatility is over. No, the volatility isn't over. 3% move is a 2 or 3% move is volatility too. And so until you get some stability in these kind of assets, um, don't expect volatility to disappear in pretty much anything else.
So Steve, now one of the things that you kind of highlight at the end of that article is talking about, what you would want to see at a market bottom. Now, clearly, it's a bear market because, I mean, by the very percentage definition of a bear market and and how long we've been selling, it is a bear market by the 20% standards. But usually, so at least often, many bear markets will end with some sort of a capitulation. Like what are the signs that you would be looking for that feels like that we're on the other side of this, like that the selling has gone far enough? Do you have any ideas of what you're looking for?
Sure. I mean, some of the basic technical measures are your 9-to-1 or 10-to-1 days, and we did get those, by the way, which is why we're off the lows right now. And what I mean by that is, take your advances over declines or up volume over down volume. I'm sorry, in this case, declines over advances, down volume over up volume. If that's a 9-to-1 or a 10-to-1 ratio, or both are, you could sort of say that's typically the sign of what we'd think of as a capitulation day. That's it. Everybody, was broad. The selling was broad based. It was horrible. It was a big down day. Everybody wanted out. That's one of those signs that make you think, okay, we had a selling climax. The problem is that does work in the short term. That's not a problem, actually. That's a feature. It works well in the short term, and that's why we set up for a decent week this week, a good week this week, for the longs. On the flip side, though, it's not sufficient. That's one of the legs of the stool. Another leg of the stool is I really think you need to see VIX getting up well into the high 30s, call it 40s, with a steep backwardation. And what I mean by that is the spot VIX or the short-term VIX futures are trading well above the next few months or futures prices.
Right.
Um, what that trade tells you is that when you see a futures market in backwardation, right? Everybody on this call probably knows backwardation versus contango, but just to be sure, contango is when you look at the curve and it sort of has that nice little, upward slope, right to left kind of thing. Or the flip side is inversion is when the shorter term is above
Yeah.
the longer term. Yeah, I see you put up a chart
Yeah.
to go with
Exactly.
it. The front part of the front of that chart is in contango. You'll notice there's a bit of a spike in October. Um, I believe that's more related to the fact that these are the result of the midterm elections. That little beep you heard was an unsolicited email from Nancy Pelosi. I'm sure that was literally her. I got to turn off the text on this machine. Sorry. Um, sorry. Um, but anyway, you remember VIX is meant to be a 30-day look ahead. So October VIX covers the election, and that's why you had that sort of hump in October. And then you sort of trail off into November and December with the thought being, okay, it's the end of the year, it's boring, and then we bounce back up. Bottom line is, looking at the left of that chart, I would expect to see, if we were really at the end of the rope, that a steep decline from left to right, with the numbers on the left being well into the 30s. Let's say July being 35, 36, 37, etc. August being the high to the low to mid 30s, let's say, and then you sort of tail off. Any 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 futures market that's in backwardation implies short-term scarcity. And in the world of volatility, that means there's a scarcity of available volatility protection. What the what the current picture shows you that you have up is there's plenty of protection. People are looking for it. Nobody's demanding it. So therefore, if everybody kind of feels that they're pretty well hedged, well, that's not the environment that makes me say people are, all the, you know, we've hit maximum fear. This is, meh, okay, we're kind of used to this new volatility.
But that is the shocking part to me, isn't it? Is that here we like? I mean, in many ways, the sell-off in the Nasdaq is now equal to the percentage of the Nasdaq drop during the COVID crash. 30 plus, some odd percent, and yet this sell-off was methodical. It was like I mean, obviously down multiple days in a row, but there wasn't like that puke in the bucket moment of capitulation that kind of bangs out a short-term bottom, but rather just a bleed. And
That's a bear
and
market.
yeah, and that really does ask the question: is that does this bear market end more with just a dull bottom where it's just there's nothing left to sell, but it just kind of bases rather than the typical V shape that we would see often during corrections that has that immediate almost like a Vanna slingshot to the upside of the market on the other side. Like, do you think there's a chance that this bear market is just more methodical and ends with a whimper?
Um, yes, although the third leg of the stool, which you actually, boy, that was a hell of a segue. The third leg of the stool, think about what happened in March of 2020. There was panic, okay? And understandably so. It was existential panic. We were all going to die from this new disease, or the
Yeah.
world was, or the economy was going to come to a crashing halt. And to a certain extent, that was that was rational panic, if that's such a thing. Um,
Hmm.
but how did it end? It ended first of all with what I call I could say it on this podcast, but some of the things that I can't say on TV, the dry heaves.
Yeah.
You really had sort of that, oh my God, we're just sort of done. The other thing was, though, the Fed moved. The Fed started, the market bottom in March of I think it was March 20th, I think was the absolute low. March 2020, a lot of 20s in there. Was the absolute low, I believe. I may be off by a day or two here or
Yeah.
there. But it was early March when they did their first rate cut, and then mid March when they did their second. And then we still actually sank for another few days till we worked through quarterly expiration. And then, the Monday afterwards was a little bit of a sell off, and then we were done. Um, do you see the Fed riding to the rescue this time? I certainly
No.
don't.
No.
And that's, to me, is the big problem. The third leg of the stool is either, we are, and it's sort of like a 3A and 3B. Either we are completely, absolutely puked out. Nobody wants to talk about equities. Nobody wants to hear about equities. Nobody's listening to nobody wants to come to my website. Nobody's, only the hardiest of souls are listening to your podcast. And I don't wish this upon you by any means. But you're in that kind of environment, or the central banks do something to change it. Well, guess what? If you're waiting for the Fed to do something to change it, it's not happening anytime soon. You got a few months. You could start to try to anticipate it. You could argue that some of this week's bounce was people anticipating that the Fed might not be as stringent as they're talking about. But in the short term, they're not riding. There's nobody on the white horse riding to your rescue. And so what you're looking for otherwise is that sort of just, God, I don't want to hear about equities anymore. And
Yeah.
and I said this to someone, one of the networks last week on air. She asked me about capitulation, and I said, I'm sorry, but you know, everybody asking me about capitulation, have we seen capitulation, is basically another fancy way of saying, have we seen the bottom? And if you're asking me if we've seen the bottom, and this is a generic you, this wasn't meant at her, this wasn't meant at you. If people are asking, oh, has that been the bottom? It usually isn't. It's usually the bottom when everybody's just kind of thrown in the towel and said, "Oh, that's it.
Yeah.
We're done." And we're not there. I don't feel that.
And how do you size up the fact that it's a unique situation? Often in the past, when the Fed has pivoted and the Fed put kicks in, it was usually in a period where obviously they realized they've tightened conditions too much and asset prices are being hurt too much, and they needed to alleviate this and come back in with money. But this time we have 40-year highs of inflation, and they have a mandate, and certainly a political pressure to now put a lot of attention on the fact that they're acting upon this high inflation. And so that's something that may not have been so evident in the last several decades. I mean, you have to go back, and I think you even mentioned it. Like you have to go back into the 70s and 80s, where a central bank was stuck with this kind of a conundrum. Like, how does that influence your thought exercise in terms of the way that the Fed reacts here?
I think that everybody involved is dealing in, I'm not going to say an unprecedented situation because there is precedent, and it may not be an exact precedent, but as they say, history doesn't repeat itself, but it often rhymes. It's sort of rhyming with, late 70s, early 80s, and but the problem is, not a lot of people active in the markets now were active in the markets then. It's just a matter of age. I mean, I talked to my dad about this stuff, but he's in his 80s. So yes, he remembers being in, he was in the markets in the 70s and 80s. But I mean, that sort of knowledge base is few and far between, fewer and far between, and not getting any greater, unfortunately. They're older. And as a result, a lot, and the rhyming part means that there's a whole set of instruments that really wasn't in play. In the late 70s, options were in their infancy. Financial futures were in their infancy. Mortgage-backed securities were in their infancy. So it's a very different environment. The vast majority of us have really not been in it. We've been spoiled. I mean, the last 13 years have been
Yeah.
the norm, but that's not the norm. It's been a situation where you've had easy money and essentially no inflation. That's actually incredibly phenomenally weird. And we have to re-reckon with that. And there's one other thing that I'm going to push back a little bit. You use the comment of the Fed put, and they ride to the rescue. I'm going to tell you very, very affirmatively that the Fed put has nothing to do with stocks. They just happen to be the happy beneficiary of the Fed put when it gets exercised. And my reasoning there is, and I wrote about this on our website. I probably should have included that, in the stuff that I'd sent to you. But um, think about when the Fed has stepped in. It's when the credit markets are in trouble. They don't give a equity markets are not in their mandate. Technically, not really as the banking system, if you believe the mandate of dual, stable prices and full employment. But realistically, in a practical sense, the Federal Reserve is responsible for making sure that the banking and credit systems work properly. And when you think about each of the various times that the so-called Fed put has been implemented, it's because there was credit. The first instance of the Fed put really being obviously utilized was 1987, and for better or worse, I had I'm going to say floor seats to the occasion. I had just come out of the Salomon Brothers training class, and the crash was horrible, but the next day was worse. And we came in, the morning meeting was, the specialist system's essentially out of capital. Nobody's got any money left. The clearing houses, the banks, they're all nervous. They can't extend any more capital. If we go down today, there's nothing to stop it. And that is actually what happened. And by about noon or 1 o'clock, most of the NYSE was offer only. Forget NASDAQ. People just weren't picking up the phone. My job literally then was move the prices on NASDAQ and don't pick up the phone. That was the main part of my day as one of the newest people on the desk. And that was it. The stock market had locked
Yeah.
up. I don't know what the right price of things were because you had no bids size for sale. And the specialists had no ability to make a two-sided market anymore. And there was a
Wow.
series of phone calls, I remember, that went back and forth. A big smoke-filled room, all the main guys in suits, all the top guys, John Goodfriend on down, Stanley Shopcorn, who ran the equities department at Solomon, a couple of his lieutenants, a couple of other guys from other departments. I think John Merriweather might have been in there. And a couple of calls. I remember hearing Stanley Mnuchin was one very specifically, and essentially Bob Mnuchin, the father, was the head of equities at Goldman, and I vaguely recall thinking it was someone from the Fed, but I can't confirm that. Bottom line is the smoke clears. Stanley comes out of the room and says, "All right, all you assholes, listen up. Any of you guys who have a stock on the NYSE, figure out what it's going to take to open the thing. I don't care what it takes. Just if there's 100, if there's 200 for sale, put in a bid for 200. Just, we need this thing to reopen. He's looking at him like, where are we going to get this money? He's like, don't worry, it's there. Money's there. Well, where does money from
Wow.
heaven come from? The Fed.
Well, the Fed, yeah.
But think about this. It wasn't the stock market. It was the clearinghouses and the banks and the clearing banks that were in trouble.
Right.
Right. So the Fed put, even though it was, originally used to rescue the equity markets in the 1987 crash, it was a credit event. And think about March of 2020. It wasn't that stocks were plunging. It was that the economy had been locking up.
All right. Well, let's use this as an opportunity to quickly talk about that. So,
Sorry, I need a beer here.
Okay, go for it. Oh, there you go. Awesome. All right. Well, I'll talk for a second while you have a drink. What I wanted to just highlight was take a quick look at what's happening here. I have the high yield junk bond credit spreads here, which while we have seen the stock markets bounce, and so some of the things like the junk bond ETF is off of its worst lows, but nowhere near the type of a recovery the way the equities had in the last week. And we look here and we see that the high yield credit spreads are actually making new highs, and the conditions are continuing to see that deterioration. Now, if we go look at a 10-year, we're nowhere near the levels, let's say we were in 2016 or 2020, where we were approaching 9-10% on these spreads. But this is actually looks like an upwards breakout in this. I mean, where's the stress point where you think that the Fed considers these things broken and that they need to step in?
That's a great question. I don't know that they have a numerical rubric on this. Again, I think it's one of these things that they know something's broken if they see it. And I think of the example of I think it was late summer, you call it third quarter, fourth quarter, 2019. As you recall, stock markets were ripping prior to COVID.
Right.
Well, why were they ripping? They were ripping because the Fed had turned incredibly accommodative in the period of around, I think it was, call it September I think it was probably September of 19, if I have to put a date on it. And the reason was because the repo system was locking up. Banks wouldn't lend repo to each other, which meant they couldn't finance anything like treasury bonds, et cetera, and on out. So the Fed stepped in and added liquidity to keep the repo market flowing. So there wasn't even a number there. It was just this weird behind the scenes event that caused them to step in. If the system is functioning normally, I don't want to put a number on what I think they're not inclined to intervene in the high yield market just to bring in credit spreads. If and when those credit spreads threaten the flow of money through the system, they'll do something. And I don't know what that number is. Could be the 5.5% of which we're around here. Could be 7, could be 10, could be not at all. So it's really very tricky. It's really very tricky to put a number on it. It's more or less, you'll know it's necessary when you see it. And it's not even something that's that visible. A lot of times, like the repo issues, it's buried way under the surface, but it's there.
So I think that's a great segue to kind of go into the article you had on Fed raising rates in a bear market and maybe a recession, and those credit spreads widening is a typical feature of what would happen during recessions, where a lot of the companies start having increased default risks and other things that have to be priced into those, and that's reflected in those credit spreads. So, what's your take on? Look, obviously, the market priced in a 75 basis point hike, and really Powell just had the layup, and he just did what the market had already baked in. But like you're highlighting, I mean, we may be already in a recession. If not, there's now a much greater chance than before that there is one coming. How do you size this whole situation up?
Well, this goes back to what we were saying earlier. We haven't seen this situation of the Fed having to do it. Let me clarify why I make this recession call. I'm not. I don't portray myself as an economist. I don't play one on podcasts or on TV. Um, but I look at the numbers as I'd like to think as carefully as any layman would. Um, and the textbook definition of a recession is two negative quarters of GDP. Right? So
Yeah.
we had negative 1.5 in Q1. So we're 1 for 2. So half the criteria is already met. One of the indicators I like to watch is the Atlanta Fed. It's called the Atlanta Fed GDP Now indicator. It's an algorithmic forecast that they have, and it's pretty good. I would no algorithm is perfect, and I say this as someone who traded algorithmically for decades. I will tell you flat out, there's no perfect algorithm, but theirs is pretty good. It's as good as anything else I found, and their estimate as of June 16th, which I believe was the last one. I think the next one is June 27th, was zero, down
Right.
from 0.9. Zero, 0.0.
That's incredible.
So, I mean, we are what, an eyelash away from a recession, if that's true. And it's not like the economy feels it's strengthening into the end of the second quarter. Granted, most of it's behind us, but today we rallied. On this, they've found like one little slender read within the sentiment numbers that maybe people's inflationary expectations are not as high as they were. I'm going to argue. You know what? You could ask all kinds of the number was at a new low on the 15th or 16th, whatever, 2 Fridays ago, I guess it was. And yet it was even worse today. It was 50.2, went down to 50. I think people are very good at expressing their sentiment. How do you feel? I feel like crap. Okay, well, but that's fair. How do you feel? I feel great. Where do you feel inflation is going to be over the next 3 to 5 year period? Really? So sure. I guess if you poll enough people, there's usually some rightness to it, and you could argue that maybe people do get it. Maybe average people do get that right more than economists. I'd love to see. There's something that I should be looking into, or if an enterprising listener wants to do that, I would love to see the results. But bottom line is, they fixated on that number, that the inflationary expectation that people have is slightly lower. It's still over 3. But again, this was a market that wanted to rally. So yeah, fine, take the data point you like, and run with it. But um, the consumer is lousy. People aren't spending money, or if they are spending money, it's on necessities. A lot of discretionary spending is coming to a halt. You're seeing Walmart and Target back with inventories backing up on them. Target to the point where they had to say it, remind you a second time. So putting all this stuff together, is it possible that we have a second negative print? For yeah, it's one of these things you won't know until hindsight. We won't know until the end. I think it's July 27th, 28th, something like that. Like last week in July is when the preliminary second quarter GDP numbers released. But you could look back on this and go, oh wow, this was actually a recession. And is it a bad recession? Not yet. I don't think people really haven't gotten into that mindset of, I'm not spending money, I'm not doing anything. But there are pockets that are getting really tricky. I think people are still spending money on vacations because they'd foregone that luxury a lot during COVID, and that's pent up. People's personal balance sheets were in very good shape as opposed to a recession where they tend to be in bad shape because they weren't traveling as much, they weren't eating out as much, they weren't going anywhere as much, and in the U.S. we had the various rounds of fiscal stimulus, but you're starting to see housing start to turn around. I know, you and I both live in two of the most sensitive housing markets in North America, if not the world, and
Right.
neither is doing all that well. At least they've been doing great, but they're faltering a little bit, and it's going to be tricky. It's going to be tough, and you don't have, again, going back to 70s, 80s is really the only precedent you have for the Fed raising rates during a recession. And anytime I have to wheel out that time frame into the discussion, it's not for a good reason.
So Steve, though, you wrote another article talking about yields or at least the curve not reflecting those recession fears, and it's interesting. I would love to kind of know how you reconcile in your mind. Like normally, yield curve inversion is something that even happens 12 months or more earlier before a recession, but now when we're having this conversation, a recession risk right now is actually seems very real. Like, how do you kind of size up the situation with the yield curves not reflecting this, or does it have to? Like, can we have a recession without a true inversion in the curves? Like, how do you make sense of this?
Well, you can have, I guess you can, have a recession it can sneak up on the bond market. Generally, though, the bond market is, if you have a tightening set of central banks, um, you'd expect to see some inversion in the yield curve, but yet
Yeah.
we really don't. I mean, it's like the VIX curve. It's very much in contango. There's maybe a tiny little hump around the 10 years, but I think that's more technical because they're being used for futures, and that's where a lot of the QE was being done. So I think the 10-year market's still a bit distorted. But I look at this, and the curve becomes flat as a pancake 2 years on. To sort of the low threes right now is the entry. I think it was 3.04 or something, 3.06 when I last looked, something of that nature. And that's pretty much flattish as you go out. 5-year was about 318, 10-year was about 313, 30 years 326. So that's showing you something, but the very short term is very steeply upward sloping. And what really came to my attention was I was just looking for a place to park some excess cash. I've been heavily in cash since the end of last year. Um, Probably actually before that. So I missed the end of it, but I've also missed the large part of the hijinks this year. Um, but looking for places to park the cash, and you have a Fed funds target that is 1.5 to 1 3/4. And I was just looking for something, some shorter term Treasury bills or something, because I'm not getting 1.5 on my money. And it turns out if you want to buy a 1 month bill, well, those are about trading about 1%. 3 month bills, sort of getting you 3 month bills, you're sort of getting closer to 1.5. And so then people look at the reverse repo window at the Fed, which is every day getting more and more money. It hits new record highs all the time. It'll be fascinating to see where that number is next week, because it tends to spike into quarter ends when
Right.
banks kind of want to clean up their books, and the last person to take the excess reserves becomes the Fed. But that number grows. Well, that's their job. I don't, sometimes it's done with repo. They need to get money on their books. Sometimes it's done with reverse repo. They need to get it off the books. Those, you see that at the end of the reporting period because they want to clear the book. They want to make the books look nice. Um, but that number continues to grow. And I realize it's completely rational if I'm the banks, because I'm borrowing it short term in checking and savings deposits and paying nowhere close to 1.5%. And they're going to the Fed, and that number last I looked was, I think, 155, right in the target range. The Fed started doing this. It really came into play last year because it was so much money that they pumped into the system that it was threatening to have interest rates go negative. And this
Right.
Fed desperately did not want that. So they basically offered to pay 5 basis points for anybody, any of the Fed counterparties would turn up at the Federal Reserve and lend them money on an overnight basis. And that number's just continued to spiral. So on the plus side, there's a lot of money floating around out there still. On the negative side, how aggressive will the Fed be about trying to mop it up?
Right.
That's really the question that we're all going to have to face. And until or unless you see that short term, the short term kink in the curve from overnight rates to, call it, 3 months, that is reflecting not a recession but just weirdness. It just
Right.
means there's so much cash out there. Look, so I hate to bring up Tina again because she's a faithless mistress, but it's not, yes, the alternatives are better, and certainly 1% on your cash looks a lot better than minus 15% on your stocks or on your bonds too. Um,
Yeah.
but it's still very tough sledding because we really haven't seen the Fed do anything to speak of.
There you go. So, Steve, I want to ask you one more topic, and then you promised to join me for talking charts, and we'll start throwing up some charts and talking about some stuff in a moment. But I wanted to kind of leave this segment with just asking you about crypto, because obviously this isn't even just about cryptos going down, but there's actual failures in the crypto system, things actually blowing up, and it's kind of rocked this world. And I'm just curious as to whether you think that there's a contagion effect to this that is more systemic, or whether or not this is just something that can stay isolated.
Um, I'll answer the second part first, and I think the good thing is it stays fairly isolated. Um, you know, I don't think that a lot of mainstream investors have what I'm going to call life-changing amounts of money in crypto. Now, again, if you've put a few $1,000s in and it's more or less, and it's down however many percent, it sucks. But I think with the exception, the vast majority of people out there, if they do have crypto investments, have dabbled in crypto, not necessarily gone all in crypto. And because they exist sort of outside the conventional financial system, you don't have that risk of contagion quite so much into the normal banks and brokers. So it is sort of its own little weird self-contained environment. Doesn't mean I'm rooting for it to implode. And again, I mentioned at the top of the show that my son is actually employed in the crypto industry, and I don't want him back on my payroll by any means. At least not until his comedy's got to kick off before the crypto thing implodes
There you go.
completely. But um, but this becomes one of the issues. It's self-contained enough. Now, the reason it's self-contained is because it's still in many ways the Wild West. I was talking about this with a friend of mine who's a senior person at one of the exchanges in the U.S. And she and I were discussing that in many ways they recreated the Wild West banking system, which was
Yeah.
Third Bank of Dodge City would issue its own scrip, and you could choose to take it or not. And by the time you went to redeem it at the Third National Bank of Dodge City, it may or may not still be in existence. You didn't have you didn't have a common currency really. You didn't have central banks. You had none of that. Well, good. You've recreated that whole world in crypto, and to me that's kind of the most uh, yes, you could argue that a lack of regulation fosters innovation, and I do understand that logic. But when it comes to people's money, we've spent the better part of 100, 150 years coming up with ways for people not to just watch their money vaporize for stupid reasons. It's what, if you want to speculate with it and you make money, you lose money, God bless you. But if it just sort of vanishes, that sucks.
That's
And
true.
so I think in many ways what appears to be a step forward in terms of innovation and deregulation is in many ways a step back, to a time that we went to great lengths to avoid, to fix. And so I think crypto has to resolve itself. I think that's why you're starting to see the bigger players in crypto realizing that the future is with regulation. Because again, if you want institutional adoption, you're not going to get it if you're the Wild West.
Right. Right. All right, Steve. Let's talk some charts, buddy. All right.
Okay.
So now, normally in talking charts, we start with looking at the top three things to watch. I just wanted to give quickly some lip service to. We didn't have a show last week, so 2 weeks ago, Kevin and I were looking at the top three things, and we were asking whether or not the market resumed selling 2 weeks ago. So that clearly was the case We talked about the U.S. dollar, which has generally been working higher since then, and the central banks, and that was really the number one, and that was really the case. The Fed was certain did come out; they did raise 75 basis points, but the interesting part to me was the going into the 75 point rate hike. The market already priced it in. And so, to some degree or another, Powell just gave the market what they've already baked into the cake. And in my mind, in order for the Fed to be trend changing in some degree or another, they have to almost throw a surprise or a curveball at the market from what they've already baked into the cake. And so, to be honest, I sort of interpret it as the market kind of got what they expected, and then the trends that were prevailing just continued. Do you have any comment on those?
I think you're dead on. And the fact, if you want to change something, the Fed just can't be the reflect what the market wants to do. You have to do something different. Now, I'm gonna say that the market made it very clear they wanted more from the Fed than 50 basis points. So to that extent, yes, he listened to the market, and he then didn't surprise the market in that regard. But I think that was I'm going to give him sort of a B minus on that one, because the market got so aggressive. The bond vigilantes. I'm going to use a term I haven't thought about in decades, but the vigilantes in the market sort of pushed him towards 75 basis points. And I guess at that point, what was he going to do? Was he going to put a 1% on there to surprise the market, or was he just going to, do the 75 basis points that was already priced in
Yeah.
somewhat painfully? I think the more interesting one is the Swiss central bank coming out of left field and raising rates. They haven't done that in 15 years.
That's incredible. It's not a huge country, but it is always one to watch, because outside of the pound and the euro, it's one of those kind of key safe haven areas in that euro land, and a lot of money circulates through there. So them moving on the rates was certainly a game changer for sure. But listen, let's talk about the top three things to watch this week. And I picked them. You didn't. You don't know what's happening here, but let's just wing it with me here
Sure.
as we talk about it. The first thing that I feel we want to watch is the 10-year yield. And for me, obviously, the reaction on the yield was on the Fed was a huge spike that saw 3.5%, and it was a very fast and rapid move, and we really gave most of the reaction to the Fed back. We started going into the Fed around just over 3%, and here we are just back around 3.13 at the time of that we're doing this recording. And the big thing for me is that all the trends that we have seen in the prevailing uptrend has been more or less rates always give little pullbacks and then continue higher, and we see this trend continuing as we approach 3%. I think there's a huge psychological level to it beyond that of it just being where all the previous highs were. And one of the things I'm watching is, will we see rates going into next week remain above 3% in this period? Do you have any views as to which way you would lean towards about where rates might go from here?
I think the steady state, I think 3% is sort of the equilibrium number for now. I think it's actually been, with even more than the 10-year, it's sort of been the entire curve. If you look at that chart, if you took off 10-year yield and put on your favorite tech stock's name in there, you would think, wow, what a fabulous chart. That is a heck of an uptrend. Yeah, it's a little
Yeah,
steep. It may need to resolve itself a little bit in the short term, but boy, what a move that thing's had.
yeah,
Except the problem is, this is not necessarily a good thing. And I don't know if you can quickly pull up a long term chart, 10, 20 years.
yeah, yeah,
Talk about a change in trend. When now that you've zoomed out, look at that. Yeah, have we possibly gotten ahead of ourselves on the up move? Yeah. Have we broken a multi-year downtrend in rates? Uh-huh.
Absolutely, it's quite. I'll have to use a really thick crayon here, but like that is definitely quite a break. And I mean that is reflective of the fact that the inflation rate has reached a 40-year high, right? Like at some point you have to think that bonds have to start or rates have to start reflecting that. And I mean that's the interesting part we find about it. So the number two, I wanted to touch on nat gas. And what was interesting is and we'll talk about oil here in a moment, but I want to focus more just on nat gas. What was interesting was obviously everyone was using the geopolitics of Russia, Ukraine, and European demand for nat gas as kind of justification why North American nat gas could be trading at $9, $10 or higher. But what I was commenting with Kevin over the last many weeks was the fact that the term structure of long-term nat gas never moved. It was completely the 2022 contracts that had these explosive moves higher. And I at least thought it was suspect, the fact that we didn't see a general rise. Like, when you always spot moves faster than farther out on the curve, but you would think that those longer term contracts should start reflecting a change in the macro landscape, and they didn't. And here we now find ourselves through what was an absolutely violent drop. I mean, we went from $9.50 down pretty much to $6 in a span of 2 weeks. Just an extraordinary drop. And what's on my mind here is was that a major top? Like, did we see something that dynamically changed here, or is this simply just a washout? The nickname of the Widowmaker that they give the nat gas contract. Is this just one of those violent corrections that has to periodically wipe out all of those people that over levered up in this space? Do you have any opinion on this?
Well, one of my little trading mantras is parabolic moves mean that someone is in pain. You don't have a parabolic up chart like that because somebody's on the other side without somebody being in some real distress.
Right.
And that, once you get into more in the earlier parts of the chart was the real panic and stress, because that was, the
Yeah,
world, and even on to the next hump there, which, that's the world reckoning with Russia, Ukraine. I get it. The rest of it, at that point from there on, the move's a bit more gentle, but you could see the volatility really increasing. And you do tend to see increased volatilities around tops and bottoms. But parabolic charts also tend to resolve themselves more or less about as violently, or if not more so, than they do on the way up, or or
Uh,
reverse, whether it's down, or they reverse as quickly as they do in the other direction. And so
yeah. On the Huddle we call that the Eiffel Tower formation.
I love that. I have heard you guys use it. I really should have thrown that into the conversation now, because it's true. Maybe it's more of like a partial Eiffel Tower, because they don't always come all the way back down,
No, exactly.
but yeah, that's exactly it. And so, the other problem with natural gas is getting North American natural gas to Europe, where the demand is higher. But I think you hit it perfectly. The tell was in the back months; they didn't really move. And like we said earlier in reference to volatility, the volatility spike, when you get that steep backwardation, it means there's a real short term need for the product, but it doesn't necessarily mean that it's anything more than a temporary supply demand imbalance. And in nat gas, that may in
Yeah.
fact be the case. Remember also, if we're going to start to get into more recessionary situations, the demand for BTUs, now you're not using natural gas in your car, but I guess we'll talk. I'll hold this back if the next one's crude. Let me hold the next thought, because if we're going to do
Yeah,
crude,
we'll
yeah.
talk gasoline and oil in a moment. But the number one thing to watch in my mind is asking the question as to whether the stock market here is just a short term little oversold bounce, or whether it's actually a more meaningful shorter term bottom. And one thing that I wanted to just highlight here when looking at that S&P 500, since more or less the last top, there have been these periods where we have these 3, 4, 5 day violent rallies that are the typical characteristics of, bear market rallies from a very oversold condition. We have these like slingshot rallies that happen. They tend to last, a week or two, and they go, 300, 400 S&P points, and then the bear market resumes. And here, like when we look at the rally, I mean, and you were highlighting the fact that we had a great week, and it was from an incredibly oversold condition. But I mean, if I turn around and just put some things like a 50 and a 200-day moving average, I mean, we're nowhere near bullishly crossing some moving averages or anything that would indicate that some new uptrend is underway. And so the bigger question on my mind is this just going to be this short-term little oversold bounce that stalls below 4,000, maybe tests its 50-day moving average, and then we have a very difficult summer as the market goes and goes through another variant of a leg down later on. Uh, do you see anything meaningful about this turn that makes it different, or is it a genuine risk that this is just more of the same?
Another one of my little market adages: bear market rallies are short, sharp, and ferocious. And I think they're normal. Remember, some of the biggest up days in history occurred during the absolute worst bear markets.
Yeah.
Um, yes, one of them in each case turned out to be the bottom, but all the others were not. Um, and so the problem is you only have one bottom, and you have a lot of trading
It-
bottoms.
yeah.
So the odds are against you that any single one, when there hasn't been, a sea, the stuff that we discussed earlier, sea change in policy, et cetera, true capitulation. Without that catalyst, it's really hard for me to say that this is anything but a bit of a relief rally. People like to chase. It's human nature. They do sort of chase these things, and we haven't come close to getting back to the longer term moving averages, the downtrend. So until I'm proven wrong, I have to take the position of, this is more
The
of a sell
prevailing trend is
the
dominant.
yeah, the trend is your friend, and this is still sell the rips kind of involved. Buy the dips,
Yeah.
sell the rips, and you don't always want to sell that first rip because that first one tends to be fairly violent move up.
You need more beer, bud.
I do need more beer, buddy. Um, so like today, if you're shorted, you got your face ripped off, but you pick your spot and you see that when you feel like you're hitting some sort of resistance point, the trend line, the longer term moving averages, that's when you start to fade it again.
So, one quick question, and just for those of our listeners that are not familiar with your background, you spent many years market making options. And what I was curious about is when you're right now looking at that left tail skews on the S&P and the way that the option market looks, is there any tells for you in terms of the way the options market looks right now that you would give insights on?
The main tell to me is sort of I'm going to say sort of the lack of skew, for sort of a better word. People aren't panicked. Now, we can certainly say that, you know, you can argue that one of the reasons we're not seeing people lever down is, okay, those people who were hedging the decline, if you had 10%, 20% out of the money puts, well, they paid off, right? So you're doing okay. I think right now the skew is, um, I'm going to say it's a little flattish. Um, perhaps even more, not terribly so. I'm not getting a ton of clues. The one clue that keeps jumping out at me is the term structure, whether you want to use it with VIX
Yeah.
futures, or it's just this flat as a pancake nature, or just the fact that the short term, we're looking at fairly low levels. The
Yeah.
individual, I'm just looking. I pulled up SPY options on my screen, so you can't see it, but I'm looking. It's like 24, 25 out to eternity. Not to eternity, but for the next several months,
Yeah.
with very low numbers in the first half. Yeah, you can argue some of that in there is, the holidays. You have Canada Day on the first. We have it on the fourth. So so there's definitely off days in the summer. But the idea that there's really going to be nothing to really make volatility tick up at any point, maybe with the exception of the midterm elections, as we talked about. Um, that's that to me
Yeah.
in some ways is its own tell. Just the fact that people are kind of copacetic with where they are. They're not demanding protection. Um, you know, and that's kind of what I keep coming back to is um, you know if you need people to sort of have that oh shit moment. Am I allowed to say that in your
Yeah,
podcast? I
you
can say whatever
totally
the hell
are.
I want.
Exactly.
This isn't this isn't a broadcast network. I can say whatever I want. You haven't had people say that oh shit moment, which means that they're going to keep chugging along and keep looking for dips. And as I said, there's still money on the sidelines, so you're just going to get this. I think you're just going to get this this
Yeah.
down stair step pattern, as long as the Fed is going to be not your
Which
friend.
is the most painful?
Of
Which is the most
course,
painful? Like at least if there's huge capitulation, big swings, it's easy to jump onto the coattail and go for a ride. But the grinding volatility is it makes it so much harder to trade.
it's
But
actually almost a grinding lack of volatility is what you get. And that's
yeah,
we have think about the last few bear cycles we've had. Sorry, I know you were going to go in a different
yeah.
direction, but I kind
You do no, let's do it.
March of 2020 lasted what, like a
A
month?
month, exactly. Yeah,
Um, December of fourth quarter of 2018 was a pretty nasty market period because the Fed was raising rates. Well, how did it end? The Fed in December of 2018 said we're going to stop raising rates.
yeah. That was it. But again, look at it. It was such a clean. It was just like a crash style, liquidation, a swing low, and and then just rocket it the other way, right?
Yeah,
It's just we lack this. And I mean, maybe last week's selling may have been the closest thing we have seen so far to just kind of short-term panic, but it's we haven't really seen even like I mean when you really reflect on it, Steve, what's crazy is that when you look at it, we haven't even really retraced half of the rally that
yeah,
we had in the last 2 years. And when everyone is talking about how bad it is, I mean, like, what if we traded back down to levels where we traded through 2018, 19, and 20? It's not like it's unrealistic, and yet it seems so far away. In order for us to trade back down to those levels, and that's the part that I would be concerned about for those buy and hold investors that think that this is enough selling. Well, there's no indication that somehow this bear market is over, and the Fed hasn't pivoted. We haven't seen capitulation. Yeah, I am in your camp, but it's we have to respect the prevailing trend until some true catalyst emerges that kind of indicates that we're on the other side of it, and that's just not there. But let's talk crude, bud.
okay,
Wow! Like, first of all, what was interesting is that we started the year with sector rotation, right? Like, it was basically defensives were working, and obviously those highly levered up tech names and unprofitable tech and everything was where the focal point of selling was. But really, the last couple months saw us sector after sector being taken down, where the selling became broader and broader, and there was one safe haven: energy. And everyone was so sure that the energy market had a bull case, and it looks like a bucket of cold water was dumped on that in the past week. What do you make of the oil selling? Do you have a thesis on this at all?
well, I do think that's another one of these, like nat gas. I think that last leg up was just sort of pure enthusiasm, squeeze the shorts, pile on our leverage, et cetera, et cetera. The one thing I look at when I look at that chart is the uptrend hasn't been broken. And
Yes.
so to me that is the biggest tell. Until or unless you really see the uptrend um, really give way, and we haven't. Um, I would say this is just some natural profit taking. I do have to wonder if a top is if it's time to start forming a top, because if we are in fact heading into a recession, if in fact people are driving less because gasoline prices are higher, if in fact fewer goods are getting shipped from place to place because people aren't buying as much, well, um, that should put some downward pressure on the demand for oil. Supply seems extraordinarily inelastic, so it really becomes a demand situation.
Right.
Um, then you could see further pullbacks. Interestingly, the question I get asked about, like, pretty much the most from friends is, should I lock in my heating oil? That is,
Wow.
now great. I'm assuming your home is heated by giant waterfalls up by James Bay, but those of us in New England, it comes in a truck, and this dirty crap comes out and gets pumped into a tank in your either in your lawn or in your basement, um, and um, and so that's a real concern with people because we didn't lock it in. Should I do it? And the problem is locking stuff in when there's volatility.
It's like
It's
buying
expensive.
puts in the middle of a crash, right? Like
Exactly.
it's the wrong time to lock in the longer term place. But like yeah, there was even a bit of a correction in gasoline. But actually, what's interesting, nat gas corrected the strongest. I
Hmm.
would argue oil on a relative basis was a strong pullback, but gas held up. Like you look at gasoline futures, I mean, there was a correction, but when you look at the magnitude of the drop in the other two energies,
Hmm.
gasoline's held up way more. In fact, it almost looks like it's turning back up here, like it's ready to go out of like some sort of a bull flag for a continuation pattern. And we're obviously going into summer driving season and all these different things. Like, do you think there's room for another leg higher here?
Well, but again, the trend hasn't been broken. In this case, the trend wasn't even tested. You would have
Yeah,
needed a drop probably, into sort of the 330, 340 range for it to
yeah,
test that. Um, so yeah, that's a tough one it's tough to bet against any of this because the
yeah.
trend is still clearly upward. Again, the supply is inelastic. There's a global situation that we don't have nearly enough clarity into.
Right, right.
And so it's tough to you can fade the trade, but it's really hard to bet against that one.
All right. Listen, there's one more chart I want to talk to you about, and then we'll get you to rate the beer. What I wanted to just talk about is Dr. Copper. And what's interesting, obviously, there was an extraordinary copper bull market that occurred throughout 2020 to the start of 2021. Obviously, EV, the demand, in new electrical grids, like copper was going to be like one of the commodities to go to. But really, for over a year, copper was struggling along its previous highs. And really, the theme during this period where this economic slowdown has happened is a pretty substantial correction. I mean, we went from a $5 peak high to now trading stone throw away from 3.5. I mean, that's a pretty deep, almost stock market style correction that we have seen here in copper. Do you have a take on what's happening in the copper market?
I think copper. First, the quick read is copper agrees with the Atlanta Fed now. um,
Agreed.
the bigger read is, I mean, you had a housing boom that was propelled by easy money, low interest rates. Yeah, it was probably more in existing homes than in new homes, um, but you could pull up a chart of lumber.
Oh
Um,
wow, yeah, like unbelievable. That's three Eiffel Tower formations.
yeah, that that's the eastern front of the Rocky Mountains or whatever however you want to
Exactly.
do it. Um, but I mean, so copper, lumber is more specifically housing cycle.
Yeah,
Copper has other uses, but bottom line is, I think the world is, I think the supply. You don't hear the supply chain being quite the problem as it was.
yeah,
Um, yes, it's more technical factors. Yeah, they can't make things in Shanghai or Beijing or parts of China that get locked down. but it's not for lack of stuff. It seems that there's enough raw materials out there, at least when it's basic raw materials. So you don't need as much lumber, you don't need as much copper. This is the economy slowing down, and I think Dr. Copper reacted phenomenally when the economy was heating up and the housing cycle was strong. Now I think it's telling you the housing cycle is turning. And remember also, commodity price inflation is somewhat of a monetary thing. And so at least if the growth in money supply is slowing, you start to see it in commodities first. Obviously, you're not seeing it in energy because of the exogenous factors, but copper, which doesn't necessarily rely on supplies from places that are in turmoil right now. You can get to it, you can get enough of it, and it seems that there's enough supply to meet the demand, and the demand is not demand's not increasing.
Oh, there you go. All right. Well, Steve, thanks for joining me for talking charts. But before I let you go, we have two things. First, you have to rate the beer. So we always at the end of the show give it a score 1 out of 10. But let's be realistic. Like Lena, you agree. Like we really do kind of rate only between 5 to 10. We rarely ever give a score of a beer below 5. And you can't give it an amateur score. It has to be a decimal point in it. So why don't you give us a rating and what you thought of the beer?
I'm going to give it an 8.1.
Nice.
You're right. There's first of all, unless it was skunked, there's probably no way I'd give it below a 5. The brewery, without being sort of like waving too much of the flag for my home state, is Two Roads is a quality product. I'd never tried their Weissen beer before. I normally am a big fan of it. It's really pretty much the only style of beer my wife drinks. We always have some around the house. But I've never tried this before. I actually sent them out, and I said, 'cause I'd been kind of stuck in the house. Sorry everybody, I just literally got over a very mild case of COVID, but couldn't go to the beer store. And I was kind of hoping for their saison, which is their worker. They call it their workers' comp. And it's a saison beer, which and they call it that because I guess that was the style of beer they used to give out in like the farmhouse to the farmhands in Belgium or something. But I'm a big fan of white beer, and they do it well. It's maybe not the top. It's maybe not as the same echelon as a Hoegaarden or a Weihenstephaner or Franziskaner, but it is for American white beer. I rate it very highly compared to some of the other suspects.
Well, when I come out there and try some of that pizza, I'm going to have to go and check out this brewery.
Awesome. Well, you know what, we need to take like a slight break from going to pizza places, so that's kind of the place we can chill for a little while. It's not too far.
There you go. Well, listen, Steve, we always give our guests an opportunity to give themselves a plug of where our listeners can follow you and find you. So where can they find you and follow your articles?
Well, you can find me on Twitter at Steve Sosnick. You can find my daily rants and raves at the Traders Insight section of the Interactive Brokers page, which it's actually tradersinsight.news, or you could just go through the IBKR Interactive Brokers website and follow along through there to Traders Insight. I have my own dedicated page. I try to publish daily. That doesn't always work out, but I get, I'd say I'm a good 3 to 4 days a week out. It's 4 to 5 average. My market's probably midpoint of a 4. I actually, I like hearing from people. So, I'm not going to, I'm going to say reach out. Don't reach out with, like, what do you think of XYZ stock over the next 2 weeks? That's not my thing. I'm not supposed to be doing that, too much with people anyway. But if you want to be like, hey, I listened to the to Market Huddle, and I don't necessarily, I'd like you to amplify your take on this, or I respectfully disagree with your take on this. I'm up for respectful disagreement all the time. If you start by you're an asshole, then I'm probably not going to respond. But if you start with like a rational argument about why I'm looking at something differently or whatever, I love that kind of stuff. So sure, reach out. Thank you.
Oh, fantastic. Steve, you're one of our Huddle favorites, and I wanted to thank you so much for pinch hitting for Kevin and stepping in. But such a pleasure to have you on the show. Thank you so much, and enjoy the rest of your weekend, bud.
It's my pleasure. You know, I'm always here. I'd love to join the show with or without Kevin. Although I do like having him around too. Don't you know? Not Wally pipping him here.
There you go.
Thank you so much for having me. It's been a real treat as always.
All right. Thanks, Steve. Have a great weekend.
Thanks. You too. Bye bye.
All right. Thank you all for joining us for another Huddle week. We're going to be back to our normal format next week. We appreciate all of you listening in. We don't have an after show this week, but Lena and I will be back with Kevin next week. So look forward to seeing you all then. Thanks, everyone.